Hey Brandon, can I really pay no taxes even though I make over $200,000 a year?
All right, so you're going to buy a short-term rental property. So let's just say the purchase price was $600,000. You get to depreciate a large portion of this purchase price in the first year using something called bonus depreciation. So the way it's going to work is that's typically going to be equal to 30% of the purchase price of the property. So in this case, we'll call it $180,000 in bonus depreciation. On top of that, you're going to get to write off any interest on the new mortgage, plus any expenses that you incur for maintaining the property. We'll call this another $50,000 for this example. You add these together, and that gives us a total of $230,000 that you're going to be able to write off. You mentioned that your income was $200,000 per year. If you write off $230,000, we'll call write-offs, against your $200,000 of income, effectively it's a loss or zero that you're going to pay taxes on. Meaning that by buying a short-term rental property using bonus depreciation to write off the depreciation expenses in the first year against that income is going to reduce your tax liability to zero in that year.
A bonus depreciation on a short-term rental can significantly lower your taxable income, especially when paired with cost segregation study. Cost segregation breaks out components like appliances, flooring, and cabinetry, so they can be depreciated over 5, 7, or 15 years, instead of 27.5, allowing much faster write-offs. In some cases, this can create large paper losses in 1 year. That's why some high earners consider short-term rentals differently than long-term rentals. But zero taxes isn't guaranteed. To potentially use those losses against active income, you usually need to materially participate. And the average guest stay must be short enough to avoid any passive rental rules. It's a powerful strategy, but it needs a proper planning and documentation. Follow us for more actual tax advice.